You wake up, check your bank account, and technically, nothing looks different. Same paycheck, same rent, same grocery store, same $12 eggs that used to be $6, and somehow you've just emotionally accepted it. But here's the weird part. You feel poorer. You didn't lose your job. You didn't make some catastrophic investment mistake. Your salary might have even gone up 5% last year, and yet every month feels tighter. You're not crazy. You're not bad with money, and you're definitely not alone. Here's the thing. The dollar isn't collapsing in some Hollywood explosion where ATMs shut down and people panic in the streets. It's cracking, slowly, quietly, in ways that are way more dangerous because most people don't notice until years later. My name is Tom, and I spend way too much time thinking about the psychology and mathematics of money. If you're someone who works hard, earns decent money, but somehow feels like you're falling behind anyway, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, most people think a currency crisis looks dramatic, but historically, it usually looks boring, right up until it doesn't. And before you click off thinking, Tom, this is doom and gloom stuff, let me challenge something right away. The dollar losing purchasing power does not mean the world is ending, but it does mean the rules of money are changing. And if you're still playing by the old rules, you're going to feel squeezed. Let's start with a simple question. If inflation averages 3% per year, is that a big deal? Most people say no, 3% sounds tiny. But here's the math. If you have $100K sitting in cash and inflation runs at 3% annually, in 10 years your purchasing power drops to about $74K in today's dollars. You didn't spend $26K, it just evaporated. Now here's the uncomfortable part. From 2020 to 2023, inflation wasn't 3%. In 2022, US inflation peaked above 9% according to Bureau of Labor Statistics data. 9%. That means $100K lost roughly $9K in purchasing power in a single year. And wages? They didn't keep up. Real wages, meaning adjusted for inflation, actually fell during that spike. So people felt poorer because they literally were poorer, not in nominal dollars, in real terms. This is the crack, not collapse, erosion. And erosion is psychologically dangerous because it doesn't trigger panic. It triggers adaptation. You just adjust. You eat out less. You downgrade vacations, you put off investing, you carry a balance for a few months longer. And that's where the second crack shows up, debt. Now here's the paradox. Inflation is bad for savers, but it's often good for borrowers. If you locked in a 3% mortgage in 2021 and inflation is running at 5%, you're technically paying back that loan with weaker dollars. That's good, but most consumer debt isn't 3%. Credit cards are sitting around 20% on average. Auto loans, 7%, 8%, 9%. Buy now, pay later everywhere. So the middle class is being squeezed from both sides. Cash loses value, debt costs more. And psychologically, this creates a feeling of running on a treadmill that keeps speeding up. Now you might be thinking, okay Tom, but the dollar is still the world's reserve currency. It's strong compared to other currencies. This sounds exaggerated. Fair? Let's zoom out. The US dollar makes up roughly 58% of global foreign exchange reserves according to IMF data. That's down from over 70% around 2000. Not a collapse, but a decline. Countries like China and Russia have been increasing gold reserves. BRICS nations have openly discussed alternatives to dollar-dominated trade. Again, not apocalypse, but diversification. If you are managing your own investment portfolio and slowly reduced your largest holding from 70% to 58%, would you call that nothing? Or would you say you're hedging risk? That's what central banks are doing. And here's why it matters to you. When global demand for dollars weakens over time, the US has less room to run massive deficits without consequences. The US national debt is over $34 trillion. Interest payments alone are now one of the largest federal budget items. When interest rates rise, servicing that debt becomes more expensive. And how does a heavily indebted government historically deal with large debt loads? 3 options. Raise taxes, cut spending, inflate the debt away. Guess which one is politically easiest? Inflation, not hyperinflation. Not wheelbarrows of cash inflation, just steady, persistent erosion. Because if inflation averages 4% instead of 2% for a decade, the real value of that $34 trillion debt shrinks significantly, but so does the value of your savings. Now here's where the psychology gets interesting. Humans suffer from money illusion. We think in nominal terms. If you get a raise from $60K to $63K, you feel richer. But if inflation was 6%, you're actually poorer. Your brain doesn't intuitively adjust for purchasing power, and that gap between feeling okay and actually falling behind, that's the crack widening. Let me tell you about someone I know. Call him Mark. Mark makes $85K a year. 5 years ago, he felt stable. Rent was $1,400. Groceries $400. Car payment $300. He saved about $1,000 per month. Today, rent is $1,950, groceries $700, car payment $520 because he had to replace his vehicle at higher rates. His salary is now $92K. On paper, he's making $7K more, but his monthly surplus went from $1,000 to maybe $300. And that's before unexpected expenses. Mark isn't irresponsible. He's experiencing currency erosion plus asset inflation. Housing, cars, education, healthcare. These categories have outpaced like general inflation for years. So when people say inflation is 3% long term, that's an average basket. Your personal inflation rate might be 6% or 8%, especially if you're young and paying rent. Now here's where we flip the script, because this isn't just a doom story. Cracks create opportunity. If the dollar is gradually weakening in purchasing power terms, what happens to real assets? Historically, assets like stocks and real estate adjust upward over time because companies raise prices and property reflects replacement cost. Since 1971, when the US went off the gold standard, the dollar has lost over 85% of its purchasing power, but the S&P 500 has compounded around 10% annually long term. That's not coincidence. Stocks represent ownership in productive assets. Cash represents stored labor, and stored labor decays in an inflationary system. So the first thing that happens next is simple. Cash becomes riskier than most people think. I'm not saying don't hold an emergency fund. You absolutely should. 3 to 6 months of expenses and high yield savings. But parking $200K in cash because the market feels scary, that's often a silent loss strategy. Now, let's do some math. Let's say you hold $150K in cash, earning 4% in a savings account. Inflation averages 5%. You are losing 1% per year in real terms. That's $500 in purchasing power annually. Over 10 years compounded, that's roughly $20K gone in real value. And that's with a relatively small inflation gap. If inflation averages 6% and you earn 3%, the erosion is brutal. Here's the uncomfortable truth. In a cracking currency environment, savers must become investors, not speculators. Investors. There's a difference. Speculation is chasing hype. Investing is owning cash flowing assets. Now you might say, but Tom, what if the market crashes? It will, at some point. Markets always correct. But ask yourself, if the dollar weakens 4% per year for 20 years, and equities grow earnings 6%, 8% over time, which side of that equation do you want to be on? The crack doesn't mean the system ends. It means the system favors asset owners more aggressively. That's the shift, and psychologically that's hard, because buying assets feels risky. Holding cash feels safe, but in a fiat system designed for mild inflation, cash is a melting ice cube. Now let's talk about what happens next structurally. If inflation stays structurally higher, say 3%, 4% instead of 2%, interest rates also stay structurally higher. That changes everything. The 2010 were an anomaly. Near zero rates, cheap mortgages, cheap corporate debt, explosive asset growth. If rates normalize higher, we enter a world where zombie companies struggle, government debt becomes expensive, housing affordability stays tight, consumers rely more on credit. That creates volatility, and volatility transfers wealth from emotional investors to disciplined ones. Because here's the psychological pattern. When prices rise fast, people chase. When prices fall fast, people panic. Both behaviors destroy long-term returns. If you buy the S&P 500 at every 10% drop historically and hold 10 plus years, your probability of positive returns has been extremely high. But most people don't do that. They wait for certainty. Certainty is expensive, and in a cracking dollar environment, waiting is risk. So what should you actually do? First, calculate your personal inflation rate. Track your top 5 expenses. Compare them to 3 years ago. Is your rent up 25%? Groceries up 40%? Insurance up 30%? That's your real inflation. Second, stop measuring wealth in dollars. Measure in assets. How many shares? How many rental units? How much productive capital? Third, increase income velocity. Inflation punishes static income. Side skills, negotiation, job hopping strategically. Data shows that switching jobs often yields 10%, 20% pay bumps versus 3% internal raises. If inflation is 4% and you get 3%, you're losing. If you switch and get 15%, you leap ahead. Fourth, own some hard assets. That doesn't mean going all in on gold. It means diversified exposure. Equities, maybe real estate if it makes sense. Maybe small business ownership. Assets that can reprice. And finally, master your psychology. Because the real danger of a cracking dollar isn't numbers. It's behavior. It's giving up. It's saying, what's the point of saving? It's overspending because money loses value anyway. That mindset guarantees poverty. Disciplined asset accumulation is the counter. Okay, so if the dollar is cracking, not collapsing, not imploding, just gradually losing purchasing power while global dynamics shift, what happens next? Here's the surprising answer: asset bifurcation. The gap between people who own productive assets and people who hold depreciating currency widens dramatically. We've seen this movie before. In the 1970s, inflation surged. The dollar weakened. Hard assets exploded. Real estate soared. Commodities ran. Stocks were volatile, but eventually repriced, and savers holding cash got crushed. Now, I'm not predicting a 1970s replay, but structurally, when currency weakens, real things reprice. And here's where psychology gets flipped upside down. Most people see higher prices and think, I can't afford that anymore. Wealth builders think, I need to own the thing that's going up. It's the difference between consumer mindset and owner mindset. Let's run a simple example. Imagine housing rises 5% per year for a decade. A $400K home becomes roughly $650K. If you're renting, your cost tracks upward. If you own with fixed debt, your payment stays mostly stable while the asset inflates. Inflation transfers wealth from renters to leveraged owners. That's uncomfortable, but it's math. Now you might say, Tom, housing is unaffordable. Rates are high. This isn't realistic. That's fair. Not everyone should buy a home today, but the principle matters. In inflationary systems, controlled leverage on appreciating assets can be powerful, not reckless leverage. Controlled. If inflation averages 4% and your mortgage is 6%, your real interest rate is 2%. That's manageable if the asset grows. But if you're paying 22% on credit cards for consumption, that's wealth suicide. Same tool, different use. One builds wealth, one destroys it. Now let's talk about the global angle. If global trust in the dollar slowly erodes, two things likely happen. The US has to offer higher yields to attract capital. Domestic asset volatility increases. Higher yields mean bonds become more competitive relative to stocks. So the era of there is no alternative may fade. That changes portfolio construction. You might see a world where 5%, 6% treasury yields are normal. That sounds great for savers, but remember, if inflation is 4%, your real yield is 1%, 2%. Better than negative, but not wealth building. Wealth building still requires ownership, businesses, innovation, equity. Now here's the counterintuitive part. A cracking dollar can actually boost multinational corporations. If the dollar weakens relative to other currencies, US exports become cheaper abroad. Foreign earnings translate back into more dollars. So large global companies may benefit, which means broad equity exposure can be a hedge. Again, not speculation, ownership. And psychologically, this is where most people self-sabotage, because when headlines scream debt crisis, dollar decline, global shift, people freeze. They hoard cash. They delay investing. They try to time. But historically, long-term equity returns have outpaced inflation significantly. Even adjusting for inflation, US equities have delivered around 6%, 7% real returns long-term. That's after inflation. Cash, negative real return most decades. So the opportunity window appears during fear, when valuations compress, when volatility spikes, when narratives turn dark. That's when disciplined accumulation matters most. Let's talk practical steps. If you're in your 20s or 30s, your biggest hedge against currency erosion is human capital. Increase income faster than inflation. Invest aggressively in diversified equities. Automate contributions. If you're in your 40s or 50s, balance matters. Some bonds for stability, but still equity exposure. Maybe consider assets that generate cash flow. If you're retired, inflation protection becomes critical. Treasury inflation protected securities, dividend growth stocks, adjustable income streams. But across all ages, one principle stands: idle cash beyond emergency needs is strategic decay. Now let's address a big objection. What if this time is different? It always is, and it never is. Monetary systems evolve, but human behavior does not. Fear, greed, overconfidence, panic, the mechanics change, the psychology repeats. The dollar cracking doesn't mean you abandon the system. It means you understand its incentives. Fiat systems incentivize spending and investing, not hoarding. That's by design. And when you align with design instead of fighting it, you win. Here's an analogy. Imagine you're standing on a slow-moving walkway at the airport. That's inflation. If you stand still, you move backward relative to people walking forward. If you walk at the same speed as the belt, you stay in place. If you walk faster, you get ahead. Cash is standing still. Index investing is walking. Skill growth plus investing is jogging. Speculative gambling is sprinting blindfolded. Which strategy sounds sustainable? Now let me leave you with something practical. Open your net worth statement. Break it into 3 buckets: cash, debt, productive assets. If bucket 1 is huge, bucket 3 is tiny, and bucket 2 is expensive, you're exposed. If bucket 3 is growing consistently and bucket 2 is controlled, you're positioned. And this doesn't require millions. If you invest $500 per month at 8% average annual return for 25 years, that's roughly $475K. If inflation averages 3%, your real return might be 5%. Still powerful. But if you wait 10 years to start, you cut that dramatically. Time compounds. But so does erosion. The dollar cracking is not your enemy. Complacency is. Financial illiteracy is. Emotional decision making is. Look, I get slightly frustrated because most people are doing everything right culturally. They work hard. They save something. They avoid obvious mistakes. But they're playing a game without understanding the board. And the board is monetary policy, debt cycles, incentives. Once you see it, you can't unsee it. The goal isn't fear, it's positioning. Own assets, control debt, increase income. Think in real terms, not nominal. Measure progress in ownership, not just dollars. Because here's what happens next. The people who adapt quietly build wealth. The people who ignore it quietly lose ground. 10 years from now, the gap will look obvious. But today it just feels like things are expensive. That's the crack. And cracks either widen under pressure, or they force you to rebuild stronger. If this shifted your perspective even a little bit, hit the subscribe button. Share this with someone who keeps saying everything just feels more expensive lately. Because they're right, and they deserve to understand why, and more importantly, what to do about it. I'll see you in the next one.